Welcome to India's 102 multiple choice question. Some of the very important questions we are going to take. Please participate and see how much you are prepared on India's 102. These are likely questions for your exam also. Which of the following transactions involve the issue of shares does not come within the share based payment under Ind AS 102. So read the options and tell me which does not come under the scope of Ind AS 102. Most of the students have replied option C. Option C, share based payment relating to acquisition of subsidiary. This is not covered by Ind AS 102. Employee share purchase plan, employee share option, share appreciation rights are covered. Very good answer. Tick mark option C. Tick mark option C. Now come to question number 2. Which of the following is true regarding requirement of Ind AS 102? Private companies are exempt. Small companies are exempt. Subsidiaries using their parents' equity share for consideration of goods and services are exempt. And point number D, there is no exemption from Ind AS 102. Most of the students have replied D. Very good answer. Tick mark D. None of the above three companies are exempted from the requirement of Ind AS 102. If they come under the purview of Ind AS 102, they will have to apply Ind AS 102 fully. Now we'll come to question number 3. An entity issues shares as consideration for purchase of inventory. The shares were issued on 1st January 2004. The inventory is eventually sold on 31st December 2005. The value of the inventory on 1st January 2004 was 3 million. Fair value of the goods received was 3 million. This value was unchanged up to the date of sale. The sale proceeds were $5 million. The shares issued have a market value of $3.2 million. Fair value of inventory is 3 million. Fair value of the share issued is 3.2 million. Question is, this can be your 4-mark exam question also. Without option, it can be a 4 marks theory question. Which of the following statement correctly describes the accounting treatment of this share based payment transaction? Come on student, try yourself. Try yourself. Try yourself. Some students are replying option A. The answer is, the correct answer is option A. Fair value of the inventory will be taken. So entry will be inventory account debit to SBP reserve account. I'll explain. Inventory account debit to SBP reserve account. Inventory will increase. SBP reserve means equity will increase. And whenever the inventory will be sold, it will be expensed. Here they have taken fair value of equity. But we have discussed first priority will give to fair value of goods received. If that is not reliable, then we'll take fair value of the equity instrument. And why this is wrong? This is wrong because they have written 2 year. There is no such concept. Same thing over here also. 2 year. Here both the figures are wrong. Amount is also wrong. Treatment is also wrong. So that was a wrong answer. Only on answer A was right. Okay, try one more question. Without option, it can be a 4-mark theory question. An entity issues fully paid shares to 200 employees on December 31, 2004. Normally, shares issued to employee vest over a 2-year period, but these shares have been given as bonus to employees because of their exceptional performance during the year. So these are already vested options. These are already vested shares. The shares have a market value of 5 lakh on December 31, 2004. The average fair value is 6 lakh. What amount would be expensed in the income statement for the above share based payment transaction? A very good question. Whatever you will think, there is an option for that. If you think the answer is 6 lakh, you have an option 6 lakh. If you think answer is 5 lakh, there is an option 5 lakh. And if you want to divide by 2, you have 3 lakh and 2 lakh 50,000. So please reply. Some students are saying option B. Option B is the fair value of the share on the grant date. That is right. We don't have to take average share. And because these are vested options, I don't have to divide by 2 also. Tick mark B. Tick mark B. Now we'll come to last MCQ for this chapter. Question number 5. An entity grants 1000 share options to each of its 5 directors. Underline number of directors. On July 1, 2004, the option will vest on June 30, 2004. So vesting period is 4 years. Vesting period is 4 years. And now the question says the fair value of the each option on grant date is 5. So 1000 into 5 directors into fair value 5. It is anticipated that all the share options will vest on June 30, 2008. What will be accounting entry in the financial statement for the year ended 30th June 2005, first year? Total estimated expense divide by 4 years. Can you do this calculation and tell me how much will this be? 6250. So I have to record an expense of 6250, credit SBP reserve 6250, check whether there is any option like this. So this will be eliminated, this will be eliminated. Now we have to make a choice between A and C. Even A will be eliminated. A talks about 25,000. So if I use elimination process, only option C will remain. Entry will be employee compensation expense account debit 6250 to SBP reserve account 6250. So this answer only possibility is option C. Tick mark option C. So these were few important questions on Ind AS 102. Thank you very much. And please subscribe to the YouTube channel AS Foundation, where we are going to upload more MCQs in the coming days. Thank you very much.